Meet Sara. It is 1998, and she is 27 years old. She is currently driving through the Florida heat, selling fax machines door to door. Her base salary is modest, her car is old, and her career trajectory looks nothing like the one her father envisioned. She has already failed the LSAT twice, effectively ending her dreams of following the family legal path. At this moment, her net worth is exactly $5,000. This is her life savings, sitting in a standard savings account, earning a fraction of a percent in interest. To the average observer, Sara is a statistical outlier in the wrong direction. She is a ride attendant at Disney who couldn't even qualify to play the character she wanted because of her height. But we aren't here to look at the surface-level frustration. We are here to run the actual numbers on how $5,000 turned into a $1.2 billion exit. Most people see the Spanx story as a lucky break or a fashion trend. They see the Oprah endorsement and assume that was the primary engine of her wealth. However, if we look at the internal scoreboard, we see a masterclass in risk management, intellectual property leverage, and a radical rejection of venture capital. Let's pin down what is actually true about the math of building a global empire from a pair of scissors and a dream. In our framework, we look at the zero phase as the foundation of resilience. This is the period before the first dollar of profit is ever generated. Sara spent 7 years at a company called Donka. This wasn't just a job, it was a 7-year masterclass in rejection math. She was cold calling businesses daily. In sales data, we know that the conversion rate for door-to-door cold calls is often less than 1%. This means for every 100 doors she knocked on, 99 people told her no. Some were polite, but many were not. This is where she built her mental moat. Most entrepreneurs fail because they cannot handle the emotional cost of a no. Sara's father had already gamified failure at the dinner table. He would ask his children what they failed at that week, and he would celebrate the attempt. This flipped the script on the standard psychological risk. Failure wasn't a loss of status. It was a data point that confirmed you were actually trying something new. While she was selling those fax machines, she was also listening to Wayne Dyer tapes, specifically a series called How to Be a No-Limit Person. This wasn't just positive thinking fluff. It was a cognitive training program designed to reduce the friction of embarrassment. Think of embarrassment as a hidden tax on your potential. If you are afraid to look foolish, you will never pitch a buyer at Neiman Marcus in a bathroom stall. Now, let's look at the invention phase. Every great business starts with a friction point in the real world. For Sara, it was the visible lines of traditional undergarments under white slacks. She took a pair of scissors and cut the feet off her pantyhose. This crude prototype solved a problem, but the math of turning a prototype into a product is where most people lose their shirts. She had $5,000. In the world of fashion manufacturing, $5,000 is essentially zero. Most consultants would have told her she needed $500,000 in seed funding just to get a prototype into production. Instead, she chose the path of extreme frugality. This is the under 50K rung of our ladder, where your personal sweat equity does more work than the market ever could. She spent months cold calling hosiery mills in North Carolina. Every single mill owner rejected her idea. They were looking at the industry through the lens of historical data. They saw a woman with no fashion degree and a product they didn't understand. But here is the part the slogan hides. One mill owner eventually called her back because his daughters told him the idea was genius. This is a classic example of market validation happening at the kitchen table before it ever hits the spreadsheet. To save money on legal fees, Sara went to the library. She spent weeks researching patent law and drafted her own application. She only paid a lawyer for the final filing. This saved her roughly $10,000 in upfront costs, doubling the effective runway of her initial $5,000. By writing her own patent, she wasn't just saving money. She was deeply learning the technical mechanics of her own intellectual property. This is a critical threshold. When you understand your IP better than your lawyers do, you are much harder to exploit in the scaling phase. Now, let's run the tape forward to the inflection band. This is the $50,000 to $100,000 mark where the market starts to recognize your value. Sara didn't have a marketing budget. She didn't spend a single cent on traditional advertising for years. Instead, she used guerrilla marketing tactics. She would go into department stores and move her product displays to the front of the aisle. She would do this while the employees weren't looking. It was a high-risk, zero-cost way to increase the velocity of her sales. Then came the Neiman Marcus pitch. This is the legendary moment where she pulled the buyer into a bathroom to show the before and after results. This wasn't just a stunt. It was a direct-to-consumer demonstration that bypassed the abstract nature of a sales deck. The data showed that if a woman saw the result, she bought the product. Sara simply collapsed the distance between the problem and the solution. In the year 2000, the Oprah Winfrey Show called. Oprah named Spanx one of her favorite things. This is what we call a multiplier event. It didn't create the business, but it accelerated the growth curve by a factor of 10. At the time, Sara was still running the company out of her apartment. She was the CEO, the customer service rep, and the shipping department. She didn't rush out to hire a massive staff or rent a fancy office. She kept her overhead remarkably low, even as the revenue began to skyrocket. This allowed her to maintain 100% ownership. For 21 years, she did not take a single dollar of outside venture capital. Let's look at the scoreboard for a moment. Compare Sara to a typical VC-backed startup founder. A typical founder might own 20% of their company by the time they reach a billion-dollar valuation. The rest is owned by investors. Sara owned 100%. This meant that every dollar of growth was a direct increase to her personal net worth. By 2012, at age 41, she appeared on the cover of Forbes. She was officially the youngest self-made female billionaire in the world. But the story doesn't end with a magazine cover. Markets change, and competition is inevitable. For nearly 2 decades, Spanx had a functional monopoly on the shapewear category. They were the verb, like Kleenex or Xerox. However, in recent years, the competitive landscape has shifted. A new player entered the market with a massive social media advantage. Skims. Founded by Kim Kardashian, Skims leveraged a different kind of math. They used influencer data and viral marketing to overtake Spanx in annual revenue by 2024. This is the reality of the catch-fire threshold. Once you reach the top, the statistical noise becomes a signal of disruption. Spanx responded by diversifying. They moved into activewear and denim, trying to capture more of the athleisure market share. In 2021, Sara made a massive financial move. She sold a majority stake in the company to the private equity giant Blackstone. The deal valued Spanx at $1.2 billion. After 21 years of holding the line, she finally opted for liquidity. To celebrate, she didn't just buy a yacht. She gave every one of her 750 employees $10,000 in cash. She also gave them 2 first-class plane tickets to anywhere in the world. This was a direct reinvestment into the people who built the scoreboard with her. But the corporate math continued to churn. By June 2026, Blackstone quietly sold its stake to HPS Investment Partners, a subsidiary of BlackRock. Following this deal, Sara stepped down from the board of directors. She was no longer the primary driver of the Spanx ship. Many would see this as the end of the journey. But we have to look at her second major venture, Sneaks. Launched in August 2024, Sneaks is a luxury footwear brand that blends high-heeled sneakers. They retail between $395 and $595. She is targeting the pain points of footwear, just as she targeted the lines of pantyhose. It is the same playbook, just with a higher price point. Her current net worth is estimated between $1.3 and $1.4 billion. She has successfully transitioned from a founder to a legacy wealth builder. She was also the first female self-made billionaire to sign the Giving Pledge. She has committed at least half of her wealth to philanthropy. Specifically, she focuses on women-led initiatives. She is effectively funding the next generation of Saras who are currently selling fax machines. We have to acknowledge the behavioral risk here. Sara's path is not the normal path. It requires a level of grit that isn't found in a spreadsheet. The math only works if you have the stomach for 7 years of door-to-door rejection without quitting. It only works if you are willing to keep your idea a secret for a full year so that no one can kill the spark before it catches fire. Optimizing for a feeling of security is what most people do. They take the steady job, the lawyer's path, the safe bet. Sara optimized for the possibility of a vertical curve. She accepted the high probability of failure in exchange for the low probability of a billion-dollar exit. We're not telling you that your current job is wrong in every world. We're just saying that in this world, with these numbers, the outlier path paid off massively. If you're wondering how she manages the unit economics of a luxury shoe brand compared to shapewear, we'll run those numbers in the next one. We run the numbers on the decisions that actually shape the next 20 years of your money.